seeing my screen well?
Yes, I am.
Excellent.
Yes, I am.
Thank you. Great, great. So, I mean, many persons know Sagicor, the entity. Just a little bit by way of our history. We've been around since 1840. So, celebrating over 180 years in the market. We are a leader provider of financial services, which would include insurances across life, health, general. So this is now in terms of, motor car, home, etc. We offer residential and commercial mortgages. So it means if you are looking for a piece of the rock, again, Sagicor could assist with that. And in terms of investment products, we are a principal player in the market with respect to our mutual funds. A very good product, and we will dive deeply into what is a mutual fund and how you can leverage the benefits of a mutual fund to your advantage. And within our asset management department, we also offer brokerage services. So if you are desirous of trading in bonds and stocks, both on the domestic market, meaning in Barbados, and also outside of Barbados internationally, we have solutions to facilitate both those types of trading in bonds and stocks. And we also provide pension investment and administrative services. Sagicor is not constrained to the Barbados market. In fact, we operate in the regional space, also within Latin America and United States. Now, when it comes to investing, we always say risk and reward go hand in hand. You cannot expect something for nothing. And in this case, it means that as we look to achieve a desirous level of return, we also must be willing to to assume some level of risk. And more importantly, we need to understand that level of risk. So when we look at the savings rate, for instance, you have money that you earn your salary, you go and you put it in the bank. Ideally, whenever you go to the bank during opening hours and you go to the teller, you obviously, and you want to withdraw any amount of those funds, clearly you do not want to hear from the teller, unfortunately, we can't facilitate your request. So your funds are on demand whenever you need them, meaning ideally you're taking very little risk, if any, with your funds. And therefore, the level of return commensurate with taking no risk, in this case, especially in this current environment, is 0%. You get probably around 0.05, which I kind of call 0%, especially when you deduct the fees the banks are charging. Now, if you have funds that you can put away for a longer period of time, you may be able to use outside of the banks some non-banking financial institutions like the credit unions, etc. And they may be able to offer you a bit higher in terms of return of like 1 to probably 1.5%. But again, you're taking very little risk. As you kind of go up the risk spectrum, you look at bonds being issued by the government. So in the past, persons always felt that government bonds were risk-free. You put your monies with the government, you leave them there for whatever period of time, whether it be a year, 5 years, and you simply harvest the coupon that they pay you, and you get your principal back at maturity. Obviously, 2018 was a sobering moment for many persons because the government of Barbados would have defaulted on its debt and indicated that it had to issue an impairment or haircut to investors. And that haircut was in the vicinity of 30 to 40%. So it meant that overnight with a debt restructure, you ultimately could have a loss. If you were highly concentrated in that investment, you could have been 30 to 40% poor by the end of the debt restructure. And then we have stocks. Stocks tend to trade on the Barbados Stock Exchange. They represent part ownership in a company. So if you want to own piece of Goddard's, if you want to own piece of Bico, if you want to own piece of Obisco, you want to be a part owner, you can go and you can engage one of our brokers within Sagicor Asset Management, and you can say, I want to purchase XYZ shares in these companies. The thing is with the Barbados Stock Exchange is that it's very illiquid. Oftentimes, persons tend to buy, persons that own these stocks already, they tend to hold them for the long term. So it means that you can desire to have ownership, but it is a case where you have to have a willing counterparty that is willing to sell that share to you. So ideally, it means that ultimately, oftentimes it's very difficult to trade on the Barbados Stock Exchange as you may desire. So just a little bit more about diversification and its importance. Now, oftentimes you hear persons say bonds are the least risky, and therefore, if you are close to retirement, if you are older, you shift your investment into bonds. This is one of those kind of approaches that I think you need to take with a grain of salt, because at the end of the day, when you are looking at a bond portfolio, the other part of it is when you shift it into a portfolio that you believe is more conservative, you are also saying, but I'm willing to accept a lower level of return. And that lower level of return may also be not aligned with your risk tolerance and not aligned with the level of return that you need to earn to sustain the goal you're trying to achieve. So for instance, if you are in retirement, you still want to earn a reasonable level of income off your assets that augments your spending capacity. So parking all your money in a bond portfolio that may earn you very low may not be necessarily the most optimal approach. What I would say though, is that you need to achieve proper diversification. So what you're seeing by way of this graph, a person who had 100% in bonds, they actually have a lower level of return and ultimately the same level of risk. In fact, they actually have a little bit more risk than the guy who would have possibly been 50% in stocks, 50% in bonds. As you can see here, he has a superior portfolio because he's actually earning a higher return while taking on a lower level of risk. And ultimately, this kind of shows you that the minimum risk portfolio tends to be a combination of about 72% bond, 28% stocks. So it goes to show you that when you are trying to diversify, you are ultimately looking at a pool of potential investments, and you are trying to see how do I blend that pool of investments whereby I capitalize on the highest possible return for the overall lowest level of risk. And ideally, this is saying that this minimum variance portfolio is 72% to bonds by having that allocation of 28% to stocks. And as you want to take on or achieve a higher level of return, it means that you have to take on a bit more risk. And in terms of taking on that risk, you are now going to be allocating a bit more to stocks. So what is a mutual fund? In Barbados, you hear a lot about mutual funds. So outside of Sagicor, you have other players within the mutual fund industry, whether it be Fortress, whether it be Royal Fidelity. But a mutual fund is where investors pool their capital or their cash together. Those pooled funds are given to an investment manager, in our case, Sagicor Asset Management. And Sagicor Asset Management takes those funds and would go out and build a portfolio of stocks and bonds, other securities where necessary. They manage that portfolio to generate returns, and they pass those returns, net of their management fee, back to investors. Now, obviously, when you look at this revolving type of process, it means that ultimately an investor who stays invested for the medium to the longer term generally is the one who comes out on top when it comes to the mutual fund investing, because he benefits from compound growth over time. In terms of the Sagicor suite of funds, for 2021, we would have seen a return of 12.4% for the Sagicor Select Growth Fund. This is an equity offering, and this is principally invested in equities. We also have the Sagicor Global Balance Fund that would have delivered 10%. Now, the beautiful thing about mutual funds within the market, they offer some distinctive advantages. So when I would have gone through the fact that you could purchase bonds and you can purchase equities, and remember I said to you that if you want to purchase these or if you want to sell equity per se in the market, you have to wait until a counterparty comes along that is willing to take the opposing side of that trade. With a mutual fund is a financial product whereby the administrator, and in this case, that is Sagicor Asset Management, stands ready to assume the opposing side of any of those trades. So you want to buy shares in the mutual fund, you come into Sagicor Asset Management, you fill out your subscription form, and you simply pay your funds in, and Sagicor issues you shares in the mutual fund. Similarly, if you want to liquidate your shares in the mutual fund, you come in and you sign up a redemption form, and by the next week, Sagicor either credits your account or says you can collect your check from in Sagicor Asset Management for the proceeds that you would have requested to be redeemed. So that is a distinct advantage because it means that these products are very liquid. They're not like a bond necessarily that ties up your money for a period of time. And though I encourage you to allocate funds that have staying power, the reason for doing so is because ultimately you benefit from investing and staying invested over the course of time. So it's not a requirement that your funds are locked up. Your funds are available to you at any point in time that you desire your funds. Now, a one-year horizon isn't necessarily a prudent way to assess the viability of an investment strategy. So what I've done here is that I've given you now kind of the 3-year average return and also extended it out to the 5-year average return. So over the last 5 years, the Select Growth Fund would have delivered 7.7%. And as we come closer in the last 3 years, from the end of 2021, it would have delivered 9.8%. And 2021, it would have delivered the 12.4%. In terms of the global balance portfolio, it would have delivered a return of 5% for the last 5 years. It steps up to 6.2% for the more recent 3 years, and then 10% for 2021. Our preferred income fund, this is the fund that is largely invested in bonds. And these bonds are across various governments domestically and also regionally. Now, in 2018, the government would have restructured its debt, and this fund would have come under some pressure in that year in particular with respect to the government of Barbados debt restructure. Now, fixed income generally, if you look across the market and you look at all the fixed income funds, you will see a similar systemic pattern of what transpired post or after 2008 with the financial crisis. What had happened is that globally, central banks would have lowered interest rates to near zero. And that would have also impacted the rates offered on longer term securities like bonds. Now, within a declining rate environment for these securities, it creates a level of a reinvestment risk. It means that as bonds that were invested years ago within the portfolio reach maturity, the proceeds that you receive, you now have to reinvest those in securities that may not be as high yielding as relative to the past. So that creates then some level of an impact on the fund's performance within the current environment. With respect to the Select Growth Fund, the beautiful thing about this fund is the equity fund, meaning that majority of the assets within this fund is allocated to equities and stocks. However, these assets are spread globally. And in fact, the best part of this fund is that majority of its assets are actually international securities. So securities that trade outside of Barbados. We hear about like the S&P 500 and all and the Dow Jones and all these is those types of stocks that represent, that represent majority of the positions within these funds. Now, in terms, and why is that beneficial? Obviously, within Barbados, we operate by and large in a foreign exchange restricted environment. It means that if you want to build an investment portfolio and you want to include international securities, you have to go through the central bank to access US dollars to facilitate purchasing those securities. And obviously, if you follow and you track the central bank, and in recent years, yes, our reserves have improved, but a lot of it is really the result of borrowed funds from the multilaterals, etc., IMF, etc., that has propped up the reserves. But if you remember, prior to that and prior to the debt restructure, our reserves were at dire levels, which meant that you had to prioritize the spend of your US dollars. And ultimately, the central bank, and I mean, they're still largely in this mode where they're not facilitating any major significant investment, conversion to US dollars to facilitate investment in securities. So they are willing to facilitate small sums on an individual basis. So for instance, if you want to take advantage on a personal level of trading in the US markets, as I said, Sagicor Asset Management also offers a partnership with Interactive Brokers. And that is a platform that can allow individuals to trade for themselves, or they can also have Sagicor execute trades for them in international securities. So persons desirous of achieving that level of exposure can come into us, speak with our brokers, and get signed up on that platform to facilitate trading for themselves in the international markets. They will have to go through the central bank, obviously, to obtain the hard currency, to fund the account, to be able to purchase those shares, because those shares trade in major currencies like the US dollar. In terms of the return profile, this kind of gives you a better appreciation for the year-over-year calendar year returns for the Select Growth Fund. So I spoke of the more recent annual return of 12.4% for 2001, but it doesn't deliver for 12.4% every year. And it's very much subject to the macro picture, what's going on in the international markets, where these securities tend to trade, what's going on in the domestic space. If there are any trades, any positions on the Barbados Stock Exchange, we have exposure to. So the performance of a mutual fund is driven by the performance of the underlying holdings within that fund. So if you remember in 2018, where you see a negative 2.1, there were a lot of volatility in the market surrounding the whole China-US potential trade war. And it meant that markets performed, and international markets performed fairly flat and relatively depressed during that period. Back in 2014, 2015, we had again threats of geopolitical risk between Russia and Ukraine, which obviously has come full circle in the beginning of 2022. And everyone is familiar back in 2018, in 2008, when you had the financial crisis, and effectively, our fund was off 12.8%, negative 12.8%. But when you compare that against major indices like the S&P 500, those markets would have been off negative north of 30%. So, there was significant volatility. But what you need to pay attention to is the graph to the left of that, which shows the performance of the portfolio over time. And what you want to see is an upward sloping trend as depicted by the graph, which shows you that the person who stays invested often generally benefits from the compounded interest that the fund has derived. In terms of the Global Balance Fund, as the name suggests, the allocation is proportionately split between bonds and equity. And this one has a tilt to the equity side, a bias to the equity side. So you have 66% in equities, 28% in bonds that can provide some level of moderation in terms of volatility. When you look at our equity funds, or our funds that predominantly have majority exposure to equities, we have over the course of time, similar to the Select Growth Fund, sought to build out the international component of those portfolios. So majority of the assets in this portfolio, in this fund, is also international. In terms of calendar year returns, looking at January 1 to December 31st, 2021, this portfolio would have delivered 10%. And you can see again, 2020 was a tough year. We had the COVID pandemic. We would have seen a recovery in equity markets. But again, performance remained relatively flat. 2018 and so forth, those are the periods that I would have identified in the Select Growth Fund's performance. And because of this fund's position into equities, they would have also endured some impact during those years as well. But similar to the Growth Fund, you want to see that upward sloping graph, which is what you're seeing depicted on the right of these numbers in this case. The preferred income, I would have touched a lot on kind of the performance over the course in more recent performance and the fact that this is the bond portfolio. So it would have been adversely impacted in 2018. And it also would have seen adverse impact due to declining yields being offered on fixed income debt globally. In terms of performance, the beautiful thing is, again, you want to see that upwardly sloping graph. And just to also touch on diversification and the benefits within the mutual fund. Now, whereas you can go and you can buy a position in a bond or buy a position in an equity on the, whether you go to the central bank or you go to the Barbados Stock Exchange respectively, when you buy into a mutual fund, you are buying into a diversified, an already diversified portfolio of stocks and bonds. So it's a case whereby you're not expected to be out there doing your own research, determining what to buy in terms of stocks and bonds. That task is effectively handed to Sagicor Asset Management and their team of investment analysts and portfolio managers, who effectively will go out and determine what are the best stocks for the fund, what are the best positions that we need to liquidate, when do we need to rebalance, etc. So in a case like even the preferred income fund, this represents a diversified portfolio of bonds. And that diversification bore fruit back in 2018/2019. If you look at the graph and even the calendar year returns, in 2018, though it had exposure to government of Barbados debt, which sustained the same impairment I spoke of with the debt restructure, meaning it was off north of 30%, that fund was only down negative 6.7%. So imagine if you had all your wealth invested in the government of Barbados debt. A year like 2018, you would have felt a significant blow and depreciation in your value. You would have seen a write-off of about 30 to 40% of that value off the top. Invested in a broadly diversified fund, you would have seen that though that exposure to government of Barbados would have sustained that level of impairment, the fund itself was only down negative 6.7%. And it speaks to the broad diversification within the portfolio. And in 2019, it largely recovered those losses experienced in 2018. So as you can see, the chart to the left almost has a V-shaped recovery and so forth. If you were invested 100% in government debt, there wouldn't have been any recovery post that restructure. The fourth fund that we offer within the mutual fund space to retail investors would have been the one that we launched recently on Valentine's Day. And this is the Sagicor Special Opportunities Fund. It is and it's predominantly within the renewable energy space. So this fund would have been developed to take advantage of the fact that many governments around the world have expressed, commitment to dealing with issues such as global warming, climate change, and they are moving towards a lot more sustainable and environmentally friendly approaches to meeting their energy needs. And as such, even within Barbados, our Prime Minister, our government has again also lent their support and their desire to become dependent on renewable energy by 2030 in a major way. So we felt that the opportunity set for such an investment is seemingly growing, and we wanted to be able to bring a product to market where the average individual can also take advantage and be a part of the dialogue in terms of investing. Now, within our mutual funds, the smallest investment to open an account is $500. Is in the reach of everyone. In fact, my son, who's 10 years old, he already has his mutual fund account, and we speak as we speak adult language when we talk in investment. So he looks forward to his investment commentary that comes every quarter, and he looks at how can he put aside portions of his allowance to take advantage of investing within the mutual fund space. So ideally, and onward investments beyond that minimum to open the account is only $100 as you seek to increase your investment in the fund. So this particular portfolio, in terms of the Special Opportunities Fund, this is going to have a balanced mandate. So it's going to be 70% equities, 30% bonds. And as I said, is also going to have a global spread in terms of its asset base. In fact, some of the seed investment into the fund since we have launched has actually been in US dollars, which has allowed us to start to build out the international book of assets. And we continue to look at the pipeline domestically and in seeking to further diversify the portfolio of investments. So if you're interested in investing in the mutual funds, and the mutual funds, because of their liquidity, because of the fact that they have diversification, so even a person who has only $500 to start with and who can only afford to, let's say, extract $100 from their salaries every month, so they're taking advantage of the minimums to invest, they are actually benefiting across the board from that pooling effect. So the man who would have put in $1 million, or the guy or the company who decided they wanted to invest in the fund and put in $10 million, look, if you were to go and try to build out your portfolio with $500, it will be very difficult to achieve optimal diversification and to benefit by way of the investments that have already been built out within the fund. So it means that by pooling within that mutual fund, you get to benefit from the guy who puts in a lot, and overall you get the same level of return on the portion of assets or the portion of shares that you would have invested in the fund. Now, to invest in the fund, what we require with Sagicor, and I'm sure as we, and for persons who may want further conversation, who would want to dissect it further and kind of see how their own personal perspectives fit into what we're offering, it means that ideally you would be able to come in, sit with asset management, and they can discuss your individual circumstances and see which fund is best for you. But in onboarding, you would just need to present 2 pieces of valid photo IDs, which could be an identification, your ID card, your driver's license, passport, and a proof of address. It could be a utility bill, it could be a bank statement. And with the bank statement, you just want to see your address and the bank logo. You don't need to see your balances. You don't need to see who went to Popular, who went to Champers, who got $1 million on the account, who got $1,000. You don't need to see any balance information or any, any history information with respect to the statement. You just want to make sure that the bank has validated your address. And it should not be any, like a utility bill, it should not be more than 3 months old. Now, in terms of the forms, if you decide to onboard with the mutual funds, you have, the application form. You'll have to complete a declaration source of funds. You'll have to complete the you call it the automatic exchange of information, which is a FATCA. This is based on the US, just saying whether or not you're a US holder and so forth. And then if you're a UK citizen, you will have to complete a data consent form, which is a couple boxes tick and just sign. And then for persons within institutions, which this may not apply to many, you'll have that customer identity form. Now within Sagicor, I would have listed a few things that you can take advantage of. So you can trade for yourself using the interactive brokers platform on the international markets. You can come in and you can take advantage of trading on the local, bond markets and the local stock exchange through establishing a broker relationship with Sagicor Asset Management. And you then ask them to execute the trades on your behalf. You can take advantage of the mutual funds. Now, before I even go on, one other thing I would say about the mutual funds is that whatever goal you have, you can utilize a mutual fund to help you achieve that goal. So for instance, as I gave the example of my son, and I have myself established an education fund for my son. Now, yes, UE has now become free again, but we don't know what's down the road. We have children, we may want them to go to, some Ivy League university. We may want them to, achieve their highest dreams and highest potential. So it means that ideally, this may come at a cost. And if it comes at a cost, we want to be ready to meet those costs. So what you can do is you can set up a fund where you actually contribute monthly towards that goal of achieving, that educational cost for your child. If you want to purchase your first piece of land, again, mutual funds are versatile investment products that can allow you to set aside money and allow that money to grow to meet the needs that you have, the various goals, whether it be piece of land, whether it be retirement. If you want to augment your retirement spend, again, a mutual fund is also a good vehicle to do so. So it's a very versatile vehicle, and you can determine which fund or which combinations of funds will best meet your needs. Within asset management, we also have recently launched Sagicor Wealth Management. Now, what wealth management seeks to do is to manage and build out bespoke portfolios for high net worth individuals and corporations. So high net worth individuals are defined by having investable assets in excess of 100,000 Barbados that they're looking to deploy. Now, we also facilitate the build out of those portfolios on the US dollar side. So if you come to us and you say, well, I have US dollars already holding within, let's say, my Bank of America account offshore, and the bank is giving me 0% interest, and I want those funds managed in a way that could achieve a potential return. What you can do is that you can set up a relationship via our wealth management umbrella, and we can then manage those funds. We partner with a international sub-advisor, in this case, Oppenheimer. We also partner with Morgan Stanley and UBS, but in this particular instance, we are partnering with Oppenheimer. And this kind of just gives you a flavor as it relates to the various portfolios that we can build out in that regard across the various risk spectrum and risk profiles. So for instance, if you are conservative, if after we speak with you, you complete the risk tolerance questionnaire, and based on the dialogue, we come to the conclusion that you have a very conservative mandate and risk tolerance, then we will ideally seek to build out a portfolio that is tilted towards the fixed income strategies with overlay of equities. Remember, when it goes back to that minimum variance portfolio, we showed that ideally that 70% allocation to fixed income and 30% with stocks tends to give you the kind of minimum variance or the lowest level of risk. So that gives you that conservative portfolio. And as we move up the risk spectrum, we can then go to moderate and aggressive, and you will see that the allocation towards equity starts to kind of overtake fixed income as we go more aggressive. And just to give you a flavor for the historical performances, as you can see, it gives you kind of the calendar year performances for the last 5 years, and then it gives you kind of the historical average annual returns that achieved. And remember, historical performance is not indicative of future performance, but it is good to at least get a sense as to how the strategy would have performed. Now, in terms of the investment climate, obviously, just to touch on it briefly, clearly global markets are very volatile to date and are actually in the negative as we speak. So when you look at what's going on in terms of major themes impacting investor sentiment, we obviously have COVID still ongoing. There would have been lockdowns in China. They would have adopted their zero tolerance. I think the greatest one is the war between Russia and Ukraine. Obviously, this have created some supply chain disruptions, and ideally, you know, we are still kind of with bated breath to see what the end result will be. In terms of the US, inflation continues to soar, and it means that ideally the Fed had to step in and start to raise interest rates in a relatively aggressive way to start to curb the inflationary pressures. Now, in terms of our year-to-date performance, obviously, we think that investors have a very good buying opportunity. What happens is that if you go to town and you had your eye on a bike, a land bike, or you had your eye for the guys on a nice belt or a nice pair of Jordans or shoes or something to that lights, you know, the best time you want to buy is when they're on sale and when they're cheap. In investments, is no different. We want to buy low and we want to sell high. The thing is about buying is that you want to buy quality. So there will be market swings. There will be, you know, as you go through the various economic cycles and business cycles, there will be peaks and there will be lows. There will be valleys. So what you want to do is that you want to buy companies that you believe in their story, that you believe in their management, you believe they have a competitive advantage, you believe that they will be around and strong enough to ride out those valleys and be able to then benefit from the overall growth over time. And ultimately, if you invest in them while they're in the valley, you also benefit from the recovery that will occur. So right now, based on the financial markets, our Select Growth Fund, remember that is the fund that has close to 80% exposure to the international markets. That is down negative 11.2% as at the 20th of May for the year to date up to the 20th of May. Our global balance, again, it has a tilt to the international side, is negative 8.3 and 13%. And our preferred income fund is negative 2.3%. So year to date, we have been a very difficult, obviously, climate to navigate. But when you look at it compared to the, the broad market indices, obviously the S&P is negative 18.7%. The Dow is negative 14. The NASDAQ, which is really comprised of the technology type of stocks, that is actually negative 28.2%, just to put it into kind of perspective. So in terms of our investment outlook, obviously we expect the rest of this year to really be a fairly rough ride. I don't think the roller coaster is over as yet. I don't think the roller coaster is over as yet. So, we have to be mindful. We don't have a crystal ball. We can't call a bottom. And hence the reason is that when the markets pull back and they're off, it creates a buying opportunity. And ideally, there's no telling where the bottom is. So yes, it can go more south before it comes north. But ideally, that is why too, it's good to invest when you're investing in these types of securities. It's good to also invest in a manner whereby you can give it a nice 3-5 year or even longer time horizon to realize the true and full benefit of your investment. And over that course of time, you add to it in a very structured and sustained and consistent manner. So, whether you decide, I can squeeze out $100, $200, etc., you continue to effectively be able to invest in that manner. So when it comes to your overall budgeting, obviously, these investments are not, and investing generally is not for you to compromise your day-to-day and operating needs. So those types of needs, you need to rely on your bank in terms of managing your liquidity. So you won't want to put money in that you can need next month, right? Those funds stay in the bank, so you cover your day-to-day, those in the bank. You have your emergency fund, whether it be your 3-month, 6-month of expenses cover, that remains fairly liquid in the bank, in the credit union, earning whatever the highest potential rate in those institutions it can earn. What you want to do is that you want to also, for funds that go beyond, that extend beyond those day-to-day needs and that emergency fund, you want to put aside in a way that gives them the best potential to earn a return that outpaces inflation. That's the only way you build wealth, right? The only way you build wealth over time is that you want to earn in a manner that outpaces inflation. So for instance, if you look at the central bank report, you will see like a moving 12-month average inflation might be closer to just around or just north of 3%. And sometimes it goes higher than that, etc. And obviously, that might again be taken with a grain of salt, because at the end of the day, that is just CPI or consumer price index inflation, which looks at a basket of goods. But there are other things that have gone up in price that may not be captured within that basket of goods. And therefore, inflation might even be much higher than what that number is really telling you. So you need to make your money work for you. And the bank is not the option to leave large pools of sums sitting down. And, ideally, we have to kind of extend this to our children in terms of helping us. I didn't learn about investing really and truly until I was able to more or less work for myself and be able then to try to find out and through my studies and otherwise, and try to find out ways of how should I go about investing, right? And it's something though that we need to start from young. So for instance, for Christmas, Sagicor Asset Management offers gift certificates for investment. And at that point in time, you can actually open an account with a much lower than, I think is a minimum of $100. So the 500 minimum is relaxed oftentimes during Christmas. And instead of me buying, the latest PlayStation for relatives, etc., I go and I say, look, give me some certificates. I'll start off at least, my relatives with the mindset of, they can then take it from there and add to it and so forth. So, it's something that we need to kind of instill. So that whole culture of investing and understanding money and so forth within our children and within our communities. So, and one more point on financial wellness before I open up the floor to all the questions and queries and, all the persons saying, how do I sign up and get started on the road to building increased wealth and so forth, financial wellness, is that part of any wellness plan, you must also, and yes, I play predominantly in the investment space, but when it comes to financial wellness, you need to also look at, do I have adequate risk management in place? Do I have adequate cover for contingencies? Because you can do everything right on the investment side. You can put aside money monthly. You can decide you are definitely saving and investing and so forth. And all it takes is one major event to significantly erode all of the hard work and all the gains that you would have made. And that's where then, having adequate health insurance, having adequate life insurance, having, whether it be augmenting your retirement through an endowment policy, all of that comes full circle and is part of the conversation in structuring a proper wellness plan, right? Because at the end of the day, dealing with cancer, dealing with ailment, like at Sagicor, they have the Life Protector, covers 21 illnesses, major illnesses, heart attack, cancer, transplants, all these different things, and so, then you have the other one, which is the Maximum Protector, which covers about, I think it's 6 or 7 of those illnesses, and requires less underwriting and so forth. For persons, if I'm a single child dealing with my parents, for persons like that, you might want peace assured. If you are the person that, if the person dies, all the burden falls on and so forth, you might decide, let me take out a peace assured, which requires 0 underwriting on the life of my parents. So, when they unfortunately have to die, you can meet the burial costs without burdening yourself or looking for that lump sum then. So there are so many products and so forth that you can take advantage of at a relatively nominal premium that you could afford, whether it be on a month-to-month basis, and that definitely benefits you and safeguard your investment portfolio. So I see it as risk management. I don't see it as an additional cost per se. I see that as proper risk management. So that brings me to the end of my presentation, and I'll be happy to take any questions. Are there questions in the chat? I can't see nothing in the chat. I see 65 persons on. It means somebody must have a question, a comment, a query. Feel free to unmute your mic and ask.
Good morning, Michael.
Hello, good morning.
Hi. You mentioned a product that you all have, Peace Assured. Could you give some details into that, please? Because I am an only child with an elderly parent. So that.
Sure. Now, and this elderly age of 70?
Yes, she is.
Unfortunately,
All right, that's
that
why
is
I asked for the details.
the cap.
Okay.
Unfortunately, that's the cap.
But you
So
can still give the details, though, no problem.
yeah,
Somebody
no
else may be
problem.
interested in it.
Sure. I will definitely get those to you. I will get you kind of a brochure, which outside of even the piece assured, it will give you information across the spectrum of products. That as I mentioned, that will be good for that type of risk management and protection against your assets.
Michael, hi.
Mm-hmm.
Just to add, I would like to hear the details around the piece assured. You mentioned the age cap, but let's say the person is under 70. What happens then? What else are you looking for to categorize, rate them, etc.?
Right.
You need to give us more details.
Okay, so if the person is under 70, and by the bear in mind that like in terms of the insurance products, I try to learn them for my own benefit, and that's why I can speak to them and say, well, look, they will make sense, but I might not be the guru. So if I don't have all the information, I definitely will get it to you. But in terms of the piece assured, once you're below 70, you normally you don't have any underwriting, so you simply have to just bring in the onboarding documentation, complete the form, get the form signed. That's why you don't have any underwriting of the person. So the person doesn't have to go and do any medical tests and all of these different things. And ideally, what happens is if the person, now there's like a 2-year window. So if the person dies within the 2 years of taking out the policy, then you get back your premiums that you paid in. If the person dies after beyond 2 years, then you get the eligible sum assured. So let's say you take out, and I think the maximum is about, if I remember correctly, about 60,000 that you can take it out for. So if you take out 60,000, and I mean, if you spend 60,000 on a funeral, that must be a big funeral. So if you take out 60,000, it means that as sum assured, and person lives beyond 2 years of the policy being enforced, then that person dies, you get that 60,000 sum assured paid to you.
Okay, Michael, we have a question from Denise Mears. So good morning, Denise. She says, good morning, everyone. If you have a small income, but you are looking to balance out your life by investing, but you're not sure how to go about it, or is investment for certain a bracket of income? I think she's asking about the security in investing.
And excellent question, Denise. Now we often used to say investments, people used to say investing is for the rich, right? If you have a small income, and that's why, honestly, that's why mutual funds were started to begin with. Because if you have a small income and you want to set aside and invest, oftentimes to achieve a diversified portfolio and to achieve the level of returns, investment in securities that give you a desirous level of return, it makes it very difficult to do so. With a mutual fund, and that's why the mutual fund, as I said, starts at $500. So once you clear that $500 hurdle to open the mutual fund account, what you're putting in is not like a life insurance policy that you must put in money every month. It becomes solely on a discretionary basis. When you have the capacity to do so, you can do so. Now, it is encouraged to formulate a pattern of investing. And in doing so, it's good to have a sustained, consistent flow that you can put into the fund. But again, it is all based on your circumstances. And everyone's circumstances, tend to be different. So at the end of the day, you know, it allows you with a small amount to pool funds with a person that may have a large amount and benefit from diversification, right? And benefit from diversification. So yes, I would say to you that, it is a case whereby you benefit, you can start with a small amount, and that's the whole premise of mutual funds. It's not for just those that may have significant wealth, but instead it can be utilized for even those that have limited capital, but still want to achieve diversification, may not be able to have the knowledge to pick stocks, etc. So, they want to benefit from the professional management and so forth. So just to tap back at some of the other questions, I put up the returns because someone, SL, would have asked for the slide showing the performance for the year. In terms of consultation, yes, we can facilitate via Zoom. We'll just agree on a time, set up the meeting link, and we can do Zoom. And if you want to come in, you can also come in. I actually am based in Wilby, so 2 minutes from BIMAP, just up the road. Good morning. Yes, I can share the slides. That's no problem. So I will circulate the slides. I'll circulate the slides in PDF format to Nicole, and she can disseminate. Oh, somebody had answered that. Thanks, Nicole. Okay, we answered that. Thank you, Harriet. Right, so the endowment, and remember, Harriet, you're putting me now in dangerous territory, but I'll try my best to explain it. The endowment is where you get one, life coverage, so you get a sum assured, along with the fact that you also you also build with a maturity. So like if, for instance, you have an endowment for 20 years, you buy in, you come, they determine that this is the sum assured within the endowment. That sum assured is paid if you achieve the age of maturity. So if you buy the endowment for 10 years, it means that that matured amount or the proceeds will be paid out at the 10-year point. If you do the endowment for 15 years or 20 years, it means the lump sum will be paid out to you at that point. Now with the endowment, they may offer additional options for payout. So the endowment at maturity with the lump sum, you might be able then to convert the endowment to an annuity. An annuity is, you could have a single premium annuity where you dump all your money in at the front, at the beginning, and if it is an immediate annuity, then you start receiving a level or equal payments over the life of that annuity, or for a specified guaranteed period of time, right? Life with a guaranteed period of time. And when I say life with a guaranteed period of time, it comes back to options like, for instance, if you decide you choose guaranteed life and guaranteed for 10 years, it means if you live beyond 10 years, you continue to get that payout from the annuity until you die. And when you die, it ceases with death. But let's say you choose life and with a guaranteed period of 10 years, and you weren't as fortunate to live beyond that 10-year period, it means that the payments even though you die, the payments continue on to your designated beneficiary up until that 10-year point. So generally with the annuity, it covers you for life. It pays you out a payment for life. But if you bill in a guarantee period, that at least gives you some onward contribution beyond your life if you were to die before the guaranteed period is up. Was that clear, Harriet? Of course. And oftentimes, Harriet, and Harriet, feel free to let me hear your voice. This is the session now where you could unmute your mics and just talk to me. So yes, if it is a case where if it is a case where you have a defined contribution pension plan, remember the reverse to life insurance almost is like the, life insurance, it becomes less beneficial is like less beneficial to your beneficiaries the longer you live, because ideally, or put it another way, for a life insurance policy, if the mortality rate goes up, it becomes more costly to an insurance company, right? Because people dying quicker, they got to pay out claims quicker. So if persons live longer, is a benefit to the insurance company. Hopefully they continue to receive premiums until, especially if the person buys permanent insurance, a whole life insurance. When it comes to pensions, the reverse is true. So pensions become a greater strain on the sponsor or on yourself to manage your flows when you live longer. So there's the longevity risk, the risk that you outlive your assets. So what people tend to do, especially those in a defined contribution plan, where the contribution that your employer makes on your behalf is determined up front, you would then usually get a lump sum at retirement. So instead of, when you get that lump sum in retirement, all of a sudden, the car you never thought you could have afforded, starts to look more attractive and look more in reach. The trips that you felt you never took, you want to now go all over the world. And before you know it, you spend all the money and you happen, because of healthcare and other things, continue to live beyond the flows, and you have to live like a pauper. So what happens is that to manage your cash flows in retirement, you often take that lump sum and put it into an annuity. You give the longevity risk to the insurance company and let them pay you a structured payment monthly over your lifetime. That way, you can spend more than you get in that monthly payment, and it manages your cash flow and the investment risk, and takes on the investment risk and take it over from you.
Hi.
So
Thanks so much for that. Quick question. So if you put it into that type of plan, what type of, is there interest on that that's garnered? Like,
right. So you would,
other than managing it is the benefit to me.
Right. So when you go into the annuity calculation, when you're ready for annuity calculation, and I can't even speak to the exact rates and so forth, that is handled by the actuarial department. So you will come in and they will take various pieces of information from you, like, your age, the amount you're putting in, different things, and they then work out, and they will tell you, give you a sense at that point in time what the payout will look like. Now, what I would say to you, because yes, I work with Sagicor, but above all, I am a finance professional who works and who gives objective, independent advice. So when you're ready for annuity, you go around and you shop around. It's no different to when you're buying a product. You don't have to necessarily shop with Sagicor for the annuity. You go around and you find out who's willing to take your lump sum and give you the highest monthly payout, which effectively informs the interest rate that so you look for the best interest rate you can get on your annuity, right?
Yes, thank you. Thanks for that.
Good. Now, if you wish to draw your money from the funds, the person asks, how does the interest rate work out? Remember, the interest rate is simply on the fund. Now, these funds are valued weekly. So every Friday of every week, these funds seek to publish a NAV, a net asset value. The net asset value, the relative change in net asset value over the course of the beginning of the year to the year-to-date period represents the interest rate. So when we talk about you having the fund down 11% year-to-date, it means that where that NAV would have stood at the end of last year relative to where it is right now represents an 11% decline. So when you come to redeem your assets, you redeem or you buy in at the next calculated NAV because the fund is always traded at the future NAV. So the way it works is that if you want to buy into the fund right now, today is Tuesday, you send in your application and all of those applications from various persons are collated, and up to Thursday evening, and on Friday they are processed at the valuation that is determined on Friday. Similarly, if you wanted to come out of the fund right now, you fill out your redemption form and you submit it. It's collated along with all those who want to come out of the fund similarly and process at the Friday NAV. So the return is automatically built into the NAV, the net asset value. So you don't have to worry about crediting, it being credited properly or whatever the case may be, because it is part and parcel of the NAV. That's clear for you? And Anadi? Yeah, we really appreciate it.
Michael, when you carry on to answer the remainder of the questions, would you mind putting back the slide where you have your contact information? Because persons are wondering, about individual consultations. So put back the slide with your contact information as you answer so they can take it down.
Yes, so in terms of updates on interest, now the beautiful thing about mutual funds is that once you are signed up and the account is open, you get you can register for online access. So you can track that said NAV, you can track the performance of your fund, right? And outside of you having that kind of ongoing web access, you also get quarterly commentaries. And what the quarterly commentaries would do is to give you a synopsis of the market, the drivers of performance or detractors, as was the case this year. And it kind of speaks to key metrics of the fund. So you look at the NAV at the end of each quarter. It will give you the net asset value, the year-to-date performance, whether positive or negative, and so forth. So you get that transparent communication coming out quarterly. Also, you can gain perspective from SAMI.BB, SAMI, which is the acronym for Sagicor Asset Management Inc. SAMI.BB. And I could type that here to everybody too. So you could go on SAMI.BB and you can actually look at historical annual reports. These funds are audited every year by EY. You can look at historical commentaries. You can, and you can navigate the full breadth of that website to gain even more information on your own if you desire. No problem, Jennifer. So you can contact me and we can get that set up. Any other questions? Okay. Thank you very much for participating and being a part of the discussion. I hope everyone got a better, some sort of understanding, some, some takeaway, some nugget, and most importantly, whatever you took away from it, act on it, right? So if you take away that you need to invest, act on it. If you took away that you need to put more, some more risk management in place, act on it. If you took away that Sagicor now offers mortgages and you're in the market for property, act on it, right? So whatever your takeaway is, just act on it. That's all I ask, and I will feel as though, my service to you is well done. So that ends my thing. Over to you, my presentation. So back over to you, Nicole.
Yes, Michael, this is Nicole. On behalf of the Board of Trustees, the Advisory Council, Management and staff of the Institute, we want to thank you, Michael, for facilitating this webinar. And many thanks to our corporate members for your continued support of BIMAP, and we look forward to welcoming you in the future activities. I would like everyone to know that Michael is available for individual consultation. Thank you.
Thanks a lot, Nicole.
You're most welcome.
All right, everyone, wishing you a good day, and feel free to engage